Now, the BOE is unlikely to hike rates today, with markets pricing in just a 12% likelihood of a change. That's drastically down from the 90% chance that investors were pricing in just over a month ago, when weaker than expected inflation, disappointing growth figures and a warning from Governor Mark Carney dampened sentiment. We'll get that decision at 12 UK time, and I will be heading to the BOE later. I'm super excited for Super Thursday. We're all excited, I think. We're joined on set as well by Elizabeth Martins, senior economist at HSBC, Laurence Mutkin, Global Head of G10 Rate Strategy at BNP Paribas, still with us as well. Elizabeth, you recently changed your call, so you were saying May and done. Now you think just done. Why such a small window of opportunity for the BOE to hike?
Well, I think when we first changed our forecast, it was back in September. We said they're going to go in November, they're going to go in May, and then the economy will lose momentum, inflation will disappoint, wage growth will disappoint, and there just won't be that urgency or the case to tighten anymore. And we thought there'd be enough momentum just to get us to May, and then we'd get that rate rise in. And that momentum's fallen away, I think, just a little bit sooner than we were expecting it to. And it may be that, you know, a lot of the weakness that we've seen in Q1 is temporary. Some of it may be weather-related. But for now, it seems like something more deeper is going on, and therefore the window, unfortunately, has closed.
What could they say today that would change your mind, Elizabeth? How hawkish would they have to be for you to have another rethink?
Well, they have to be pretty hawkish because, to be honest, we know that they're minded to raise rates. When we forecast the rate rise in May, it wasn't because we thought there was an urgent case to raise interest rates. It was because the Bank of England was sending consistent signals that that was their intention, that's what they wanted to do. So we know that they're minded to do that, and I would be surprised if they've completely turned around from that. So we're expecting them to be a little bit hawkish, to want to keep the door open. The problem for us is that the data have been so weak, and we don't expect a big improvement in that.
And you don't expect to hike this year or next. But if we look at this chart, the market does seem to still be pricing in one hike in 2018. Is that right, Laurence? Should it be pricing that in?
It does, but it's come back a long way from what it was pricing in, following, as you say, this bad data and the more dovish comments that Carney had. But I think it's worth saying, when we look at the fan charts, even though they're presumably going to tilt down a bit, we're still going to look at an inflation outlook that's going to be above the target on, you know, all the way out to the forecast horizon. And again, it's worth asking the question, why then aren't they going to respond? And their sort of get-out-of-jail card has been this thing about exceptional circumstances. And I think they more or less say they mean that this is the context of how will Brexit develop. But there's an implicit thing here that the Bank of England is saying, we are tolerating above-target inflation. We're doing it because of this exceptional circumstances clause. I mean, from my perspective, that's not a costless decision, you know. And I think that, yes, it's supposed to help the economy continue to run on, you know, but, you know, to help the economy to continue to run on, to avoid a possibility of a recession, by allowing inflation to run high, I mean, frankly, it's a low-key version of the way the UK economy's behaved since, I don't know, the Second World War.
Right.
You know, and I'm not sure that it's really in the. It's a judgment call as to making that decision.
Elizabeth, is Brexit the reason you don't see that there will be another hike this year? Because, as Nera said, there is some expectation in the market that there could still be one this year. But the timing, when you overlay that with the politics, is that why you say it won't happen until
It's part of it. It's part of it. We don't know what will be happening with Brexit in November time. I mean, it could be that it all goes very smoothly. We move straight into a transition. But I think our broader view is just that inflation is going to disappoint and wage growth is going to disappoint, and there just won't be that argument. I mean, the Bank of England will make the case that, yes, inflation's a little above...
disappointing inflation could still be inflation above target, could it?
Well, in their forecast, yes, absolutely. I mean, inflation is coming down now. It looks like it's peaked. And in their forecast, I think it's about 2.1. So it's 0.1 above target. They would argue that incorporates the market curve, so incorporates the rate hikes the market is expecting. And if you didn't have those, then it would be much higher. So they're kind of saying there are going to be rate rises, but perhaps not just yet.